Hi, this is Dr. Y, the retirement practitioner. The idea of stopping to work for money and making money work for you is not new. Investing for income is not supposed to be a riddle either. Toronto, New York, or London, as one Baker Street detective told his retired doctor friend over 100 years ago, "Elementary, Watson. You know the method, apply it." So you find some bonds and blue-chip dividend stocks, add liquidity and diversification with ETFs, buy low, sell high, watch your commissions and fees. You keep winners, buy on dibs, and identify losers to get out as soon as possible. And you keep clipping coupons all along. But if it's all so simple, why aren't we all winning? Stock markets started in the 17th century, and by 1914, the London Stock Exchange boasted trading 1/3 of all public capital in the world. Since the times of Holmes and Watson, people invest pretty much the same way. Sure, we have keyboards, screens, and smartphones, but what we do has not really changed. Experts and brokers in financial districts use their experience and skill sets going through news and research to try to pick tomorrow's winners. They decide what to buy and what to sell based on what happened yesterday and happening today. The problem lies in Mark Twain's observation. Forecasts are tricky, especially about the future, and brokers are no exception. They are human beings driven by emotions, motivated by compensation, susceptible to cognitive biases, and often employed by large profit-driven corporations. Like the rest of us, they mistakenly associate familiarity with safety, are reluctant to admit mistakes, and tend to show stubborn overconfidence. But the most damaging of all is FOMO, fear of missing out and looking stupid while everyone else is making money. Deeply rooted in herd mentality, FOMO led to market crashes throughout history. Driven by irrational exuberance, brokers and clients alike are happily stampeding towards higher commissions, exotic alternative investments, and riskier rewards. Until the bubble finally bursts, bear market bust follows. Herd stampedes right over the cliff as prices crash. Income investors learn their lesson, say never again, and inevitably add insult to injury by tossing away income streams and missing eventual market recovery. There has to be a better way that does not cost an arm and a leg, and there is. This method is so counterintuitive, investment pros call it contrarian. Remember when George impressed his romantic interest by announcing himself as unemployed and living with his parents? That is exactly the approach to popularity that works in income investing. Do the opposite might work in a sitcom, but surely in efficient markets described in 1952 by Nobel Prize winner Harry Markowitz, that would be an anomaly. And it is. 66 years after Markowitz, Richard Thaler won the same prize for advances in behavioral economics. One of his first articles on the subject in the Journal of Economic Perspectives was called, you guessed it, a closed-end fund anomaly. To remove anomalies, most rule-based investment strategies simply remove emotions from the investment process. Our rules-based selective top 50 yield and discount index does more. The opposite of panic and greed is not nothing. It is opportunistic and cautious, rational cherry-picking, if you will. This is how we pick. Our system screens 512 funds for management fee, size, liquidity, yield, and most importantly, net asset value discount, collecting income streaming assets free. Finally, the cherry on top, we plug in more data and use a statistical indicator called Z-score. It shows how unpopular or popular an asset class is at any observation point. Twice a year, around tax loss selling time and cottage season time, the index rebalances. The popular, expensive funds get sold. The higher-yielding ones discarded by poorly informed sellers get scooped. Now let's talk about the elephant in the room. In near-zero rates and GDP growth, cost is everything. We can reassure MER watchers. Every year, CEF net asset value discounts will beat a percentage of assets going to fees by a mile. And then there is a behavioral gap. That name describes a 3.5% difference in average returns of investors buying and selling funds compared to holding exactly the same funds and doing nothing. Actually, doing nothing is okay, but following the Z-score is better. Without going into statistical jargon, Let's just quote Morningstar and say Z-Score can help investors uncover truly undervalued and overvalued funds. Practically unknown in Canada, the method is now available to you with us standing by to fill in the gaps, behavioral or other. Finally, we decide to do what every successful strategy eventually does. After practicing our craft for 18 years, we created an index and we're planning to launch an ETF. In today's realities, to say things changed and finding income is important is an understatement. Just like all cars have sophisticated computer diagnostics, but your mechanic still knows when you should put on winter tires, we brought in the human factor, opposite in the form of a Z-score. Investor mood and Z-score can change about as fast as Canadian weather in winter. If you snooze, you lose. Which is why we keep an eye on the top 50 CEFs in the index and share the scores with you, so that you could scoop unpopular income streams. To continue this Sherlock Holmes analogy, Scotland Yard was and is pretty competent solving cases, but they need a consultant for the deeply fascinating ones. If you'd like us to do dividend discount detection for you, we would like you to have an idea of what we do. Our updates and best ideas will always be one click of a button away. You'll feel secure knowing what we suggest is the result of a rational calculation and not dictated by a need to earn a commission or some knee-jerk emotional reaction. Our services are available through combined resources of aligned capital partners and the National Bank Independent Network. This setup delivers a cost of service advantage, proper regulation and compliance, and there is no need to overpay for the safety of having one of the Canadian chartered banks as your money custodian. By following our rules-based method, we have more time to focus on your needs and help you stay unpuzzled, unstressed, and in control. I am Dr. Y, the retirement practitioner. Bring me your frequently asked but unanswered investment questions, and we shall un-FAQ them in no time.